Well, investors hope the second half of 2016 looks nothing like the first half, which was full of volatility and market-moving events. Here with his playbook for the rest of the year is Nardin Baker, the chief strategist at Guggenheim Partners. So, Nardin, we might hope for less volatility in the second half, but we're not likely to get it, right? Of course, especially after this market-moving Brexit vote that we just saw. How would you characterize the markets as we head into the rest of the year?
Well, markets always have some volatility, but it's been increasing in the last couple of years. So events seem to cause a spike in volatility. Volatility may fall and then stay at a somewhat higher level than in the past. And we don't know what those events are going to be, but investors need to be cautious about taking too much risk right now.
Okay, and you say there's a way to sort of align your portfolio during these types of times where you can get compensated during times of volatility. I want to show this chart basically showing that yellow line is a measure of the volatility in your portfolio, and then there you see those shaded parts. Those are times after high-risk stocks have been beaten up. These are periods in the markets that reward volatility. And look, you can go into these very high-risky stocks when sort of the bumps have been smoothed out. So I think the question is, how do you construct a portfolio that gives you the best of both worlds, strong performance and lower volatility?
Well, smart beta strategies, and we would put optimized volatility in that category, have been drawing a lot of assets because they're systematic and things happen automatically to keep an investor invested. Here, with optimized volatility, we do something pretty simple, which is measure which stocks have been rewarded in the recent past, high-risk ones or low-risk ones. Then we find an optimized portfolio that tilts towards those either high-risk or low-risk, the ones that are being rewarded. What this does is something really interesting. It makes the portfolio dynamic. It'll change its risk exposure, but it only does so after the market has started to reward risk. So in those high-risk periods that you pointed out, the strategy automatically shifts out to the high-risk stocks once the market has started to pay for them.
And this is something that everyday investors can do.
Well, it's difficult to do because of the mathematics, but through an ETF, you can get exposure to this strategy, optimized volatility, and you don't have to do anything in terms of making decisions. In other words, we're always measuring what the reward to risk is, and the portfolio automatically shifts the exposure. So as an investor, you don't have to go through that agony of trying to decide when to increase your risk.
Okay, moving on to sectors you're looking at in the second half. What really is on your radar?
Well, what sectors have been risky lately? We know that financials have been, and we know that energy has been. It's not true that those areas are yet being rewarded. So our exposure has increased recently to energy, but only a little bit. And in financials, we're still at a pretty low exposure. Again, this is simply an automatic process. If the market were rewarding financials, automatically we would be shifting in that direction. Now, we rebalance every quarter, so this is a fairly slow-moving approach, and it tries to get it right for the next year or so.
Now, during the first half of 2016, stocks were largely directed by oil. Is that a trend you expect to continue into the second half? And are there other trends that you think might move the stock market, perhaps the price of the pound versus the dollar?
There are three things that I think are connected. Well, a couple that you point out, the pound dollar, or in general the dollar's strength. Then there's energy. And finally, it's what's going on with the financials. Are we in a stable period where interest rates are going to bottom and start back up because growth is going to continue? Or could we see lower interest rates where they're forecasting reduced growth? Energy will probably calm down. Financials will be somewhat dependent on global growth. Energy is, I guess, dependent on global growth as well. But I think the key is watch the dollar to see if it remains high and stable, and watch interest rates, particularly the 10-year bond. If it stays low at 150, we're probably in for some slow growth.
And, are you expecting a Fed rate hike in 2016?
No.
Certainly because of that Brexit as part of it, right?
Yes, and in general, the markets, if you look at future curves, they're not forecasting much growth or much inflation. So the Fed would like to raise rates, but they're not really compelled to at this time.
Yeah, they really backed themselves into a corner. All right, Nardin Baker from Guggenheim Partners, thank you so much for coming by.
Thanks, Scott.
I'm Scott Gamm, and you're watching The Street.